Welcome to the CNBC-TV18 Citizens Monetary Policy discussions. The upcoming RBI policy has become a deeply divided debate after the second quarter GDP growth came in at a strong 8.2%. Yes, the governor said Reserve Bank has space to support growth, but is there a need to support growth has become the new question. Joining me are Citizens MPC members Soumya, Kanti, Ghosh of SBI, Samiran Chakraborty of Citi, Sonal, Varma of Nomura, JPMorgan's Sajjid Chinoy, and our chairman, Dr. Pronab Sen, the former chief statistician of the country. Gentlemen and Sonal, thank you very much indeed for your time. Actually, let me start with the lady. Sonal, 8.2% growth. How can you justify a need for a rate cut? Will that pull back the MPC's hand?
Yeah, Latha, I mean, clearly it's a tight decision this time around. I think taken at face value, the 8.2 and for FY26, where we are now tracking closer to 7.5, does not suggest there is a need. I think we need to sort of dig a bit deeper, though, and a more nuanced analysis in terms of to what extent do we take these 8+ readings on GDP at face value? What is the role of low deflators in actually accelerating the real growth? Do we think that the output gap in India has turned positive based on the broader swath of economic data, including the credit gap, current account gap, momentum in core inflation, etc.? And I think the forward-looking view as well, I mean, as the deflator is going to drop even further into the negative territory in Q3, and that will again hold up real GDP in the next quarter. So we'll be having the same debate 2 months later. And therefore, I think, the forward outlook in terms of do we think steady state growth has stabilized in the 7.5 to 8% range? If not, if growth is going to revert back to 6.5, 7%, then the output gap is not significantly positive. So I think at face value, yes, there isn't a need, but I think we need a deeper analysis and discussion on the nominal growth slowdown and whether we think output gap has turned positive. Our view is it is not positive, and the deflators are exaggerating the real increase.
Okay. Sajjid Chinoy, if you have joined us, a similar question to you, actually. Is there not increasing conviction, at least for the last 3 or 4 quarters, GDP is coming higher than market estimates. So maybe we are in a higher potential growth. Or do you think this is a one-off blip because of the low WPI and we will revert back to 6% and growth needs help?
Well, Latha, good morning. I'm not even sure we need to go into those assessments when deciding what the RBI should do. What is the RBI's mandate? The primary mandate here is to keep inflation close to 4%, right? While keeping an eye on growth or while supporting growth. But it's very clear that the primary mandate is on inflation. And, 10 years into an inflation targeting framework, it's very important from a credibility perspective to implement the mandate symmetrically. If overall headline inflation was tracking 6%, which is the upper end of the RBI's corridor, most analysts would say the RBI needs to hike rates here. This year, overall inflation, even if before the GST cuts kicked in, was running at about 2.2 or 2.3%. If you look at underlying inflation, which is to look at core inflation, correctly adjusted for gold prices and fuel prices, that's been running at less than 3% for a year. So if your primary mandate is to keep inflation close to 4, inflation is currently at 2%, underlying inflation is running at 3%, suggesting that there is still slack in the economy, it's very clear to me that, the decision is clear that you need at this point to cut rates to maintain the primacy of your mandate. Judgments about, output gap are harder to make, but if underlying core inflation is running at 3%, that still tells you there's slack in the economy. And so the RBI needs to be supportive of that at this point in time. So I think taking a more puritanical view of the inflation targeting framework, which I think is the right thing to do at this point in time, avoids, some of the questions that Sonal raised.
Okay. No, I agree. But, the RBI has not been all that symmetrical. During COVID times, even when inflation was above 6%, they did not hike with good reason. So, I mean, there have been exceptions to the rule, but we will leave that to the official MPC. Let me get to Soumya. Soumya, the RBI also looks at forward inflation. And that, given the low base, may be close to 4% or even higher. So do you think we can run away, assume a rate cut simply because the last number was 0.25%?
No, I think we are living in a world of uncertainty, and a new uncertainty is the GDP, strong GDP growth, which has now become a certainty. So my sense is that I think let's dissect it into the following points. The first thing to note is that I think inflation, forward guidance of inflation in a situation when there is significant uncertainty is always very difficult to give. I think we started the year, the central bank started the year with an inflation forecast of 4% in April. It went down to 3.7, 3.1, and now there is a 2.6. Now there is every possibility that the final inflation number could be closer to 2%. Next year, we have started with 4.9. We are now at 4.5, but with the new CPI base and given the current inflationary trends, I think I will not be surprised if it runs decisively below 4% also for the next year when the MPR report is published in April. So having said all this, I think so the 1 year forward guidance at this point of time, looking into it and making, even though that's actually the mandate of an inflation targeting central bank, is very difficult to make. Okay. So my sense is that while I agree with the point that inflation is going to undershoot significantly, but you also have to admit that growth has been strong. Last year, we were having a debate that why the GDP is so high from the GVA. That was because of indirect tax collection. This year, we are having a debate that whether the GDP is high because of deflator. Whichever way we can argue, we need to understand that the GDP growth has continued to be strong. We can also look into the arguments in terms of a glass half full. For example, the nominal GDP growth rate could have been higher and the GDP growth could have been lower, but that's not been the case. So we need to take a sacrosanct view. Yes, inflation will significantly undershot, but at the same point of time, in a world of uncertainty, you have to keep the gunpowder in your arsenal over a longer period of time, and there is no harm if the rate cut cycle or the stance of the central bank remains in this current mode, at least in the near future. Because what is important is the understanding of the current scenario in terms of growth inflation trade-off.
Okay. So I'm smelling the first person who's not going to vote for a rate cut, but we will wait. Let's get to the other big issue. Samiran Chakraborty, on the trade data and the BOP, will that be a worry that we have deficits both in the current, rising current account deficit and persistent capital account deficits? Will that be a worry for the Reserve Bank?
Thanks, Latha. I guess from the October policy to the December policy, if I have to find out one factor which has changed really rapidly, that has been our expectation about the balance of payment deficit. We were thinking that there's a possibility that this October-December quarter could actually turn out to be much better for BOP, but whatever we are tracking, this quarter could be somewhere around $15-20 billion of BOP deficit again. And that would mean that for the first time ever after at least 1991, that India is going to have 2 consecutive years of BOP deficit. And that's something which at different levels would feed into the policy decision also in our view. And it's 2 ways. One is obviously in a BOP deficit situation, you would want some amount of interest-sensitive flows to come to the country. And to that extent, there is lesser need for rate cuts. And second is that this BOP deficit feeds into INR liquidity and in turn feeds into bank deposits. We are already seeing banks' credit deposit ratio reaching all-time highs. At this juncture, further rate cuts could worsen that pressure on the credit deposit ratio. And to that extent, also, there could be an argument for RBI to wait out till hopefully by the 4th quarter of the fiscal, we start seeing the BOP start improving. Then maybe it's a better time to consider the rate cut.
Fair enough. But some may argue that this problem should be better addressed with liquidity, but I will come to that in a bit. Dr. Sen, as the former chief statistician and a person who has seen many cycles of deflator surprising us, what would your advice be to the Reserve Bank about the quality of growth and whether it needs help?
Well, this is an important question, Latha. The fact of the matter is that as the current system stands, our estimates on nominal GDP are far more accurate than our estimates of real GDP.
Oh.
The nominal GDP are really current data. But then you're using price deflators, which have been outdated by many, many years. And then it gives naturally a rise to a suspicion that too much is being driven by the prices. The nominal data is tracking weak, but prices are tracking even weaker, which is giving you high real. Now, so the whole question is going to be not so much as to what your expectation of inflation is, but the extent to which the MPC actually trusts the price data.
Oh.
Is the price data telling me the truth and nothing but the truth? So far as agriculture is concerned, the worries on that count are less. But insofar as everything else is concerned, whether it's the CPI or WPI, I think there are grounds for serious concern.
Oh, okay. So it looks like you're going to advise caution, sir, but why don't we put it to vote? We'll take one vote now and then take a second vote at the end of the second half of the discussion. So the first question I'm going to pose to my guests is obvious. What will the MPC do to interest rates, repo rate, on December 5th in the policy? Let me start with you, Sajjid. What do you think they'll do?
A 25 basis point cut.
Thanks, Samiran.
A pause.
Pause. Okay. Already there's disagreement. Sonal?
25 basis point cut.
2 cuts and 1 pause. Soumya?
We are going for a pause.
2 cuts, 2 pause. Chairman, casting vote, sir?
Pause.
Pause. Okay. So our Citizens MPC is going with a no-cut expectation for December 5th, but it is a close vote. Let's take a break. We will continue our conversation and ask the more serious questions on liquidity, global impulses, and what will be the next steps in monetary policy coming up after the break. Welcome back to the CNBC-TV18 Citizens Monetary Policy Committee deliberations. The committee has just voted with very narrowly for a pause policy, for a no-cut policy. But we have to discuss many more dimensions, most important of them all being liquidity in the markets. Of course, I have with me Samiran Chakraborty, Soumya, Ghosh, Sajjid Chinoy, Sonal, Varma, and our chairman, Pronab. Samiran, the liquidity question is to you. You said that, the outflow of dollars on capital and current account has created a tightness. Is not this crying for more liquidity steps rather than rate steps? What steps are you expecting?
Yeah, obviously, right now we are in the process of seeing what the last phase of the CRR cut, which just happened, that will probably boost the system liquidity in the short term. The month-end banking system liquidity is not terribly tight at this moment, but we know that as we move into the fourth quarter of the fiscal, because of seasonal reasons, the liquidity will get even tighter. So obviously, RBI will have to guide that they are comfortable providing that liquidity. And clearly, OMO is one of the instruments to do it. The debate is that whether it's too early on December 5th to signal OMO. In our view, it's probably better for RBI to just acknowledge that in the secondary market, the OMOs that they have already done, that was a conscious policy choice and not just a random event. And through that, try to signal that if there is a need for OMO, then RBI will be open to doing that at some point of time in late December or early January. The bigger question that I was raising was not so much about the system liquidity, but simply the pressure on the bank deposits.
Okay.
We think that that's the place which gets really impacted by a persistent BOP deficit. And that's why to cut rates now when the small savings rates are unchanged could create a distortion in the system, which could be putting pressure on the overall credit growth. The banks might be constrained on that, so the transmission could get impacted because of that.
Oh, yes, that's a fair point. And that perhaps also was the reason why the Reserve Bank in earlier times also did not cut, because the transmission could be impacted. On the liquidity front, Soumya, what is your sense in terms of how much OMOs the market is expecting or ought to be done?
Yeah, thank you, Latha. I think regarding the liquidity front, I think the important point to note is that I think the communication to the market. So basically, the central bank has been doing an assiduously and a delicate job in balancing the liquidity, but the issue is basically also short-term liquidity and long-term liquidity. So basically, the question between friction, the temporary and permanent. So the issue of basically how much OMO the RBI needs to do will depend on how much durable liquidity the RBI can keep that question open. The market expectation is that if the central bank is targeting 1% of NDTL surplus, the OMO operation could be around 1.5 trillion or so. But having said that, I think the more important point is that signaling to the market that the central bank will going to be continuously supporting the liquidity, because at some points of time, when you are doing a liquidity withdrawal through a short-term mechanism and a liquidity injection through the secondary market OMO, the market actually could think otherwise, that there is both the policies are at play, withdrawal and injection. So the central bank needs to clearly communicate that what is the purpose of doing an OMO and what is the purpose of doing an the reverse repo operation or so on. So I think that is the market is looking into, and like any other policy, signaling to the market in terms of maintaining adequate liquidity buffer for any unforeseen circumstances will actually have a very good impact on the market in terms of an impact on the GSEC needs.
Oh, yes, communication really important. And I'll ask that questions to the other members as well. But before we get to the stands and the communication part, Sajjid, just highlight to us, what is the global environs? I mean, isn't there a big Asian disinflation, so inflation will continue to be low? What should the RBI keep in mind?
Good point, Latha. 2-3 important points, I think. Number one, that, while on the surface things may look very stable globally, there are lots of uncertainties below the surface. Yes, US growth is tracking 2% this year, but you've never seen this kind of divergence between capex and growth and the job market. The job market has virtually come to a stall. And so I think the US economy faces an important resilience test the next 3 months, because you've got a situation where labor incomes have slowed. The impact of the tariffs is building every single month. So core inflation is going to keep creeping up till March. And in an environment where job growth has slowed, labor incomes have slowed, and there's a purchasing power squeeze that's building in the next 3-4 months for US households, will the US household bend or will the US household break? That's an important known unknown, number one. Number two, a lot of growth around the world in the US is being driven by AI. Concerns that this is a rising bubble and could unwind sharply in the coming months is uncertainty number two. Uncertainty number three, as you said, is China has been redirecting its exports to all parts of the world. So even though US inflation may be high, remember Asian inflation is going to be, in our mind, structurally much lower, in this world. So I think there are a host of global uncertainties, which means central banks around the world can't be complacent that all is well in the world. We touched upon the fact that there are uncertainties on India's GDP print. Some of this is deflator, some of this is favorable base effects early in the year, some of this is fiscal front loading. So there are a lot of uncertainties, which is why if inflation is so low, you want to provide some insurance to your economy in this moment. We think the Fed's going to cut in December as an insurance cut. And I think that's why, given the weakness of inflation and the quantum of uncertainty all pointing in one direction, that's why I think it'll be prudent for the RBI to provide another insurance cut this month.
Okay. Sonal, Varma, the stance is going to be neutral and nobody's expecting a change there. What kind of guidance should they give or will they give?
Yeah, Latha, I think it all boils down to communication at this meeting, because regionally, what we've seen with central banks that have been on hold or those that have cut. I think the broad market view is central banks are moving towards the end of the easing cycle. And therefore, even where central banks have delivered cuts like New Zealand, we've seen actually market interest rates go up. So managing the expectations channel of monetary policy will be important, as we've seen with India's own history, where with a 50 basis point cut in June, rates sold off, and the October pause dovish actually led to a positive impulse.
Yes.
So I think in terms of what the RBI communicates, therefore, I think from an inflation point of view, we actually see inflation staying below the 4% for the next at least 9 months. And this is despite base effects. So I think the comfort on inflation is substantial. And therefore, the guidance, given our view of a rate cut, I think should still be one of
Dovishness.
independence, and the monetary policy will do what it needs to do, because we need the transmission, whether it's through the bank lending channel or through the market expectations channel, to continue rather than unwind, as we are seeing is the risk regionally.
Okay, so you are arguing like your vote also was for a cut. So RBI can communicate dovishness. Dr. Sen, what would your advice be? Ultimately, it depends on communication. What would you do in their shoes?
Well, this is a bit of a problem. I mean, frankly, if I were in the RBI's position, I would be feeling distinctly uncomfortable. At the moment, what do I communicate? I think a lot of the communication is going to have to be about saying that we are not behind the curve.
Okay.
We are, in fact, ahead of it. And that's going to be a little difficult to do. Because frankly, at least on the liquidity front, I think RBI has dallied much too long. M0 growth has fallen rapidly. M3 is rising. But if you look at the figures that we've been looking at, agricultural food prices are down seriously, which seems to suggest that currency is in short supply. And that is something that we need to keep our eyes on. Okay. And I don't think RBI is going to explain what they're doing on the liquidity front.
Okay.
Up to now, their only communication on the liquidity front has been the CRR cuts.
Yeah.
But they've kept their mouths absolutely shut about what's happening to base money.
Okay. No,
I think it's about time they came out and said something about it.
Yeah, I know the liquidity was an issue a year ago, but now they seemed proactive with, as you said, CRR and a lot of liquidity infusion. The point is that...
Only at the Q3.
Yes, but the liquidity has also been withdrawn in a huge way because of BOP. So, I mean, the RBI is in a quandary as to how much it will communicate. Okay, what is your view, therefore, members of my MPC, Citizens MPC? How many more cuts are there in this cycle, including December 5th? Sajjid?
Just one cut, 25 basis points, including December.
Okay. Soumya?
Yeah, just one cut. We are keeping the option open of an insurance cut in the future if it happens.
Okay. Sonal?
50 basis point.
Oh, 2 cuts. Already there's a dissent here. Samiran?
I don't think there is any further rate cut in this cycle.
Oh, that's even more divided. 0, 1 and 2. Dr. Sen, Chairman?
I agree with Samiran. I don't think there'll be any further rate cuts on this side.
All right. So this is a divided house, and with good reason, because the data is confusing. On this note, let's wrap up on this edition of the Citizens MPC deliberations.